Hey everyone, it's me again. It's Revenue Ravi. Thank you for clicking on this video. This video is going to break down exactly what's going to happen when the Fed finally drops the interest rates, or as the pros call it, when the Fed pivots. And this is a big deal now because it's going to happen very soon. These past years, we've seen interest rates be at their decade highs. They're affecting everyone from the working class to the banks to you at home. And naturally, the market's feeling it. With higher borrowing costs, a cooling housing market, and overall slower economic activity, it's going to get even worse because interest rates, they're lagging indicators. So believe it or not, even though life is still very tough, interest rates have still not yet fully been realized into the market. But here's a real question. When is the Fed actually going to pivot? So if we listen into the top analysts, they've been saying that the Fed is going to cut the rates in the beginning of 2024. Obviously, that did not happen. In fact, most of the times when top analysts make a prediction, it's usually wrong. Let's not look at that. Instead, I want to take you a different direction. Look at this tool here. So this is where we can find the actual probabilities on when the Fed may cut its rates. As you can see, as of today, August 5, 79% of the market thinks that the next FOMC meeting, the Fed will pivot. 79% is a big number. That's the majority of the market. So 79% of the market, they think that the Fed is actually going to pivot next meeting, which is in September, I believe 11 or 12. I may be wrong on that, but it's 6 weeks away at least. And also, we cannot forget the rest of the people who think that the Fed is going to keep the rates the same, which also may happen. But obviously, guys, time's going to tell. But for now, this is our best tool that we have. Now let's look into the past and understand what's happened previously when the Fed's pivoted before. Let's look at this chart. Now, contrary to what most people think, the market doesn't do well with the Fed pivot. As you can see in this chart, each time there was a Fed pivot, the market dropped. The only case it didn't drop and actually went up a little was in 1980. And for the rest, they've all experienced a downturn. In fact, it averages out to be negative 23.5%. That's bad. Let's understand why this happens, what that negative 23% actually means. So the only time the Fed would pivot is when the market is struggling. And when the market struggles, obviously companies and their valuations tend to be under pressure. The standard of living drops for people. Things get too expensive. Their pay doesn't get them as far as it used to. And as a result of that, people flock away from stock investments. For those who had investments, they take it out. For those who were thinking about investing, do not anymore. Instead, they focus on safe haven assets like the US dollar or, let's say, gold. Now, I know some people are going to say that, hey, stocks are forward-looking. By anticipating a future recovery, the stocks are not going to go down and they're going to keep going up. Now, that's a great thought and you are correct. Stocks are forward-looking. But let me tell you this. Every time the Fed raises interest rates and then they drop it, a recession follows. And because the market also understands that a recession may come in, that is a reason why the rates go down, the stock market goes down. In fact, I'm going to show you this chart on the screen right here. Every time the rates went up and they went down, a recession followed. And I'm also going to put in the link for that data in the description below so that you can check out for yourself that historical data that's been played out over the past decades. But so far, I've been giving you bad news after bad news. Recession's going to happen. Things aren't going to go your way. Standard of living's going to drop. Let's look at some of the positives now. So first of all, we're probably going to end up seeing a reversal of some of the pain points that currently exist today. And that's mainly for the housing market. Lower rates mean lower mortgages. And the fact that people would be able to get cheaper loans is going to breathe life into the real estate market once again, because currently it's so cold. So if you're looking to refinance or get a new property, you may actually be able to get a good rate on the loan. So that was it for the positives, only the housing market. But guys, the reality is a reality. It cannot be changed. This is a business cycle we're talking about, so you must let it roll, and we must let the recession, the inevitable recession, come in and do its thing so that we can go into the recovery phase and live our life happily ever after. Not ever after, but you know what I mean. If you liked this video, if you found it helpful, hit the like button, hit the subscribe button, and comment below on when you think the Fed is actually going to pivot. Let me know. Let's have a conversation in the comment section below, and take care of yourself. Have a great day.